I continue this time with the risk management module we started coding in MQL5 in the previous episode. I'm still focusing on the primary objective of getting the value at risk at the moment for a single asset, and look today at the code to convert the lot size into a monetary amount that value at risk requires. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now, or find further links in the description right below. Now back to today's tutorial. The value at risk calculation necessitates the need for a monetary value of a position as opposed to the lot size alone. I take you through the process I use in MQL5 to ascertain this, and then show you how this fits into the value at risk formula itself. Let's take a look. So having coded the part of the formula in blue here, the standard deviation, last time, we now turn our attention to this third component of the formula, the amount invested, and effectively converting a lot size into a monetary amount. So this is where we got to last time. We calculated the asset's standard deviation of returns and simply outputted that to a message box for the user to see the value. Then we just returned false and we didn't go any further. So now, concentrating on the nominal value here, I'm just going to paste in the code that we require. And I'm going to move the return statement below here. And this time, instead of reporting on the standard deviation, which we've already seen, we'll instead report on the nominal value that we've calculated. Now previously I said that to keep things fairly simple and generic for this calculation, I would stick with currency pairs, and the reason for that is that the vast majority of brokers provide the calculation of the monetary values in the account's currency, which of course is what you want. However, when you move into other asset types like stock indices and commodities, they're often provided in alternative currencies, and so there's a currency conversion that has to take place in order to convert them to your account's currency. Now, all brokers do this in a different way. So, for example, some brokers like Darwinex will quote the Nikkei index in Japanese yen, whereas other brokers might still produce the values in USD or sometimes in the account currency, whatever that is. And this varies from broker to broker. So to avoid any confusion, I'm going to stick with currencies, but I've put a note here that there would be a to-do that you would need to do that conversion depending on what your broker used. But let's keep this simple at the moment and just use currency pairs, and then I will show you what that currency conversion line of code needs to look like in a future episode. Okay, so this is the value ultimately that we are interested in, the nominal monetary value. So I'm just going to copy that to the message box so that we can report on that instead, and because this is a monetary amount, I'll just keep it to 2 decimal places. So let's take a look at what this is doing. So we're using some standard MQL5 functions here called SymbolInfoDouble, and you can request lots of different metrics for a particular symbol, and the two that we're interested in is the symbol trade tick value and symbol trade tick size. Now the size, first of all, represents the minimal amount that the asset can change in value by. So for a 5-digit currency pair, this will be 0.00001. And the trade tick value tells you what the value would be if you were holding a one lot position in that particular asset that moved by that minimal amount. And so by dividing this value by this value effectively tells you what the value would be if you were holding a one lot position that moved a full 1.0 in its price. So this is a unitary value, if you like, that I call nominal value per unit per lot here. Now, once you've got that, it's a relatively simple process to then convert that to what the monetary value is for the whole position. Because if we multiply that value by the current close price of the asset, this tells you what the monetary value would be for one lot if the price went from where it is now all the way down to zero. So effectively how much you would lose if the asset lost all of that value. So in other words, trading on one-to-one leverage, so no leverage at all. But remember that's for one lot, so we have to multiply that by the asset's position size, and that gives us the actual nominal value that we then can use in the value at risk calculation. So let's take a look at this in action. So if we come back to our calling script here and just compile that, again, we've got 0 errors, 0 warnings. So now remember that this will be calculated in the account currency. So my account is in British pounds. So that's what we'll get our answer in. So let's just run this now. And initially we'll just do it for euro yen and 0.1 lots. Click OK. So we can see that the nominal value for 0.1 lots, if we were trading without any leverage at all, and we were actually buying this asset, would be 8,365 British pounds. Now, there's a way that you can check if this is being calculated correctly. And to do that, we can open a manual position in this, which is euro yen 0.1 lots. So here we can say new order, set the volume to 0.1 as we had a moment ago, and you can see that MT5 actually gives you the monetary amount here, 10,000 euros. So this is being quoted obviously in the base currency, which in this case is euros. And so if we just convert that 10,000 euros into pound sterling, we can see that it's 8361, which is pretty much the value that we got a moment ago. Let's just run that again. 8360 now. So we now know that that's being calculated correctly, and we have the next piece of the puzzle now in place in order to be able to calculate our value at risk. So in the next episode, we're going to complete the calculation of the value at risk, and I'll talk about how you can then consume that within the calling script or the expert advisor. And then in the episode that follows, I'll then start to turn my attention to calculating the portfolio value at risk. And of course, this is what we actually need to be able to manage the risk of our portfolio. But of course, we couldn't do this until we'd done the more simpler version using a single asset. And so the first step of this is going to be the calculation behind the portfolio standard deviation as opposed to a single asset standard deviation. And it's that will then feed in to a very similar equation for value at risk at the portfolio level. Now, it's always extremely appreciated if you could give me a thumbs up if you've got any value from today. If that next episode that I was talking about is already released, then you'll see it top right now. But until next time, trade safe.